cautious in the market.
Okay. Sanju, one of the big sectors that were in focus this week was the entire FMCG space. How have you read the news on Nestle as well as ITC, where there was that news about the loose cigarette ban in the state of Maharashtra possibly coming through?
Given that most of these FMCG players have 30 to 40% of their sales coming from rural areas. I will not specifically comment on Nestle or ITC. Between the two, I like ITC. While the results for the fourth quarter were nothing much to write home about, the interesting point is that despite a 14 to 15% fall in volumes, the revenue growth, was still static. I had anticipated the revenue growth to actually inch several notches down, which did not happen. But personally speaking, I think there's so much to choose from within the FMCG space that you really don't have to get into controversial stocks like ITC or Nestle. If I have to look at the pecking order, it would certainly be something like a Dabur, an HUL, a Marico, and an Asian Paints, perhaps in that order. I think one very interesting point, which needs to be, brought home is that in the fourth quarter, the volume growth for some of the biggies surprised in the positive, be it an HUL, which had a volume growth of 6%, or Dabur, which had an volume growth of 8%. I think what increasingly that tells you is that demand is slowly but surely coming back. And the reason why the top line growth was muted, despite a volume of growth of 6%, you only saw a sales growth of 9% from HUL and a 10% sales growth from Dabur. That is because I think companies chose to be discreet, companies chose to be smart, and they passed on the input cost deceleration onto the customers and did not get greedy in terms of raising prices. And I think that was also reflected. The input cost fall was reflected in margins expanding by between 80 basis points to 120 basis points for all key players within the space, be it HUL, be it Asian Paints, be it Dabur, with the sole exception of Marico, which saw a small contraction in margin. So my point is that I think FMCG does look interesting, and for all those who are screaming their lungs off that rural demand is just not picking up, I think people seem to have missed the point that if you take the April inflation print and read in between the lines, rural inflation actually came in at 5.37%, more than the urban inflation at 4.36%. Something which was amplified by Marico's numbers, where the rural growth was 24% year on year, whereas the urban growth for some of their products was just about 18%. So I think rural growth is coming back into the system, but it will take a while before it becomes more visible and more lumpy. So I think as I said, FMCG is something that I'm surely betting on, because when you buy an HUL, you don't want to look at the 30 times or 40 times that it's trading at, but the fact that the return on equity and return on working capital is at 100% and more. So you look at different parameters for different stocks, and I think in terms of efficiency ratios, FMCG stocks certainly rule the roost.
All right, Bala, you were mentioning that, from a risk-reward point of view, the downside for this market looks limited now. So if we do manage to see a concrete rebound, between two of these pockets, banks and technology, where do you see the highest amount of returns now?
I think banks are an ideal bet. I'm actually not that positive on IT space. That doesn't mean I'm negative there. Basically, what I'm seeing is that the cycle from 2012 lows to 2013 lows, most of the stocks seems to have completed a complete cycle. Once that happens, we could see a complete, a sizable correction come through for the rise from 2013 lows to the highs of 2015. So that's the reason why I'm a bit neutral on IT. But banks, they still have one more leg up. I think from a medium-term perspective, 3 to 6 months perspective, I think banks are heading towards 22,000, 23,000 on the bank nifty. So that presents a tremendous low risk and high reward potential. So that's the reason why I'm positive there. If you look at something like an Axis Bank, I think it's looking at, you can look at something like 750 over the 3 to 6 months time frame. And even if SBI were to break the 255 level that I spoke, I think the downsides are about 8 to 10%. But once that is done, the short-term correction would be done, and the longer-term trend will take over. So with relation to IT and banks, I'm positive on banks more than IT.
Okay, well, time for a break now. But as we do that, let's get in some market opinion we've had through the week.
We are calling for a flat market into the year end at this point of time. So I would say it's probably close to its fair valuation. But I must confess that there are a couple of red flags which, I'm no soothsayer, but one part could be that in case the monsoon disappoints as the IMD and various other agencies have forecasted, then there is obviously some kind of downside risk that could open up on markets. China, it still remains to be seen how much, valuations are still not as expensive as what you have relative to our market at this point. And at the same time, you also have an issue in terms of what happens to the passive pools of money.
One thing which I'm really worried, and I don't know the time frame for it playing out, and that is the global situation. Again, let's take record that last 5 years, global tailwind has been in our favor. Interest rates are virtually at 0%. There is enormous amount of printing of money which has happened around the world. I don't think, just as being in the market for 20 years, I don't think these are sustainable situations. However, these are big macro calls which are dependent on 15 things.